Hi, welcome to the Investment Blueprint. I am your host, Raghu Kumar from Rain Platforms. The Investment Blueprint is a podcast where I interview traders, investors, quants, and finance professionals in the space of retail trading and investing, with the goal of helping pass on their knowledge to you. Today, I interview Abhi Patel, a retail trader who has been building quant strategies since 2014. Abhi is a lover of math and probabilities, and he uses this to his extreme advantage with his trading. He actually appeared on the famous show Sensex Ka Sultan on Z Business a few years back, and he won the competition in his city. And he considers himself to be a very competitive trader. He was also one of the highest ranking traders on OpenTrade, an initiative Zerodha had launched a couple years ago, where star traders could share their trading calls with others. Today, we will go through Abhi's history as a trader and touch upon why he feels so strongly that quant-based trading is the best way to trade. So, Abhi, welcome to the podcast.
Thank you very much, Raghu, for having me here. I'm sure, next 20, 30 minutes will be, great. Great understanding for our viewer and listeners. Yeah.
Let's make the most of it. Yeah. So, Abhi, let's start with your general background. How did you get into trading and investing?
Okay. So, first of all, the first introduction, happened to me for the trading and investing when I was in 6th standard or 7th standard, right? So basically, there was a magazine called Capital Line, which is fundamental driven magazine, which come to my home. My father used to study the PE ratio, book value, and so on and so forth, right? So I was basically, fascinating about, the stock market, how the stock market works, or how, this ratio will leads to me, leads my father or to me the profitable, right? So I noted down few points. I keep on asking them the question that what is the PE ratio? What is the book value? How the face value will work and so on and so forth. So they will try to explain me all the concept, and I'll remember those concepts as of now as well. But then, I start realizing that these concepts may not actually work. Let's say, my father was telling me back then that, Reliance P is, let's say, around 18 or 19 back then, right? So is that P is lesser, you should buy the Reliance share. And next day, when I saw the, ticker tap on the CNBC, I saw, share is falling. So if my father is saying the P ratio is lesser, you should buy the shares, and now the share is falling, there is a total disconnect, So I thought, this particular thing ignites on me that, why this is a disconnect? What is the source behind, actual price movement, right? So this is actually thing, which ignites me. Then after, I have been keep on studying the same, but the truth of the moment come when I have to select the stream after my 10th standard, right? So you either have to select the science, commerce, or arts, right? All of my family member are expecting I'll select the science stream only, right? Because I was a bright student back then. But I choose the commerce stream and want to pursue my career in financial markets. So they were little surprised, but the surprise did not very longer, because I topped in my district and I got also 99 marks in the statistics, right? So they were happy that, these guys doing good, even it's a commerce, these guys doing good. So that is the first initial step. And yes, then, to venture the full journey as my trader, right? So I joined the NISM basically, the SEBI led institute, where I have done the full-time financial market courses, right? Which specialize on the financial market. So NISM provide me a great platform, it's like a sandbox, in our quant trading term, or we can call it a simulation environment for me, where I've been learning a lot of new concept. Back then, even I use Excel sheet to design some quantitative based strategies. Okay. And I actually, a lot of the students over there,
Okay.
they were just there to, study the concept or maybe to get the job. Okay. But I was not there for, just study the concept or get the job. I was actually looking for the practical applicability. Okay. So I was also trading. So what I was doing, I was designing some strategies on Excel. Then I actually implement those strategies. I earned a good profit back then as well, right? But once my strategy is working, let's say for a week or for a month or so, right? I'll stop studying those strategy. Okay. And I'll look for some new other strategy that, okay, I know these strategies work, right? But I don't know how depth, the market will have, right? So I have to, hope around the different strategies, right? Very, very fortunate for me is that, in my initial phase, even I didn't lose any money. Even I have not earned any money when I was in college, but I didn't lose any money, even though I was hoping from, strategy. Then I thought, after the college, I thought, let's start the, the trading thing, right? So believe me, I had a first account with the Upstock. Okay, I have been trading with the upstock initially, but then Zerodha come up with some good feature like 60-day challenge, and they will give you your brokerage back. So why not? I'm a
Right.
profitable trader. Why not ask for the
Why
brokerage
not?
back, right? So
Yeah.
yeah, I switched to Zerodha
Yeah.
then after. 1 year passed, 2 year passed, then Zerodha come up with the one platform called Open Trade, right? So basically, they
Right.
invited. I
Yeah.
don't know, somehow they, I mean, see my account and they invited me, to join their platform and publish my trade to every subscriber.
Yeah.
So basically, whatever I trade, every
Yep.
people whosoever is my subscriber will get to know what this guy is trading, right? And one point of time, I was the
Right.
highest followed trader. I mean, that was very amazing thing for me because I feel that
Yeah.
I'm doing something apart from others. So that was a zeal that I had. Yes.
Right. Got it. That's amazing. A lot of things to kind of take away from there. The first thing that I want to take away from there is that P ratio gap still exists today, right? So even if you were a young ubby today, learning the stock markets, you'd probably still see some of that phenomenon happening and get puzzled. So it's pretty amazing. And it seems like you've always had like a very mathematical curiosity behind everything, which probably takes you a long way. So I wanted to kind of shift gears a little bit right now. I want to talk about this show, Sensex Gus Wilzang, right? Because I've seen the show obviously many times. So just tell me your entire experience with that show and how did you end up doing so well on it?
So basically, all start with that, I was surfing the Money Control website, right? So there is a, advertisement just bottom of the Money Control, which says, there is a Sensex Sultan show, presented by or hosted by the Z Business and the BSC together, right? And so I
Right.
thought, I should give a trial. At least, I will check, where I can feel, in the hierarchy of the traders, what is my skill level is, right? So yeah, I opt for the same. So basically, there is a 2 round. One round is the offline round where thousands of participants presented. Participated on it. So basically, the first round is called designing your portfolio. So basically, they ask you to design the portfolio out of top 500 Nifty 500 company and just hold it for 1 week. You can change one or two company in between as well. And whosoever gets the higher return are qualified to come to the main stage. The only 4 people managed to come to the main stage whosoever portfolio is outperforming, right? So yeah, out of maybe 100 or 1,000, my portfolio was ranked in the 4th number, right? So I managed to come to that stage first of all, right? But when I come to the stage, there is all odds again, stakes against me, right? Because there is a 50% counting of this particular thing, that the portfolio thing. uh, Ultimately, final winner will be 50% weightage given from this portfolio and 50% from the stage appearance and stage interaction, right? So all odds against stakes against me, right? So still, I managed to sail through. I'll give you the very exact reason, why I have sailed through. First of all, yes, definitely I have the knowledge, right? Uh, and second thing, I have the knowledge of the probability which other participant may not have, right? And I'll give you, the question answer was not based on the probability, right? But I figure it out that, if I play a game with the probability, I could win. I'll give you the reason. Let's say there is a 20 question or buzzer round. Okay. And for every right answer, you will get a 1 point. And for every wrong answer, you will get a minus 25 point, right? So basically, if I give a 1 correct answer and 4 wrong answer, still, I will be at the break even, right? So what I was doing, even though I know the answer, but I keep on putting on the buzzer. Buzzer after buzzer, buzzer after buzzer in rapid fire round, right? Let's say even though my hit ratio is a 10%, 50%, right? Out of 20 question, if I just give the 10 answer correctly and 10 answer wrong, still, I'm up 7.5% or something in net basis, right? And other guys are still zero, right? So that is the exact odd. I was playing against all other them. They were not understanding what these guys doing, but I was exactly using the probability. It was not a question of the probability, but very fortunately for me, 70% of my answer, 65 to 70% of my answer was also correct because I had a detailed knowledge. So yeah, that was a pretty much good experience. Pretty for other guys.
Right. That's amazing. No, it reminds me of, my schooling days where, you have these scantrons, A, B, C, D, E, right? Same thing, if you get it correct, you get a certain point. If you get it wrong, you get penalized, but it's never equal to the amount that you get right. You get if you get the question right. So, I remember doing the same thing, with my exams in school. Right. Okay, so let's talk about quant trading. Obviously, you seem to be a very strong proponent of quantitative trading and investing. What was your general introduction? So you mentioned the fact that in college, you were always kind of mathematically oriented, but when it came to your trading, when did you start developing your first, quantitative trading systems?
So yeah, the same thing, since the college, I was been doing, with the Excel. I use the Excel model, and then I, trade with my own discretion. But, few years ago, I guess, in 2014 or so, my cousin, approached me. He's a Python developer. He asked me that, I mean, the market, I know the coding. Why not, quantify all the things? That time, pure quantitative trading was a very new thing for me, right? But still, I guess, that should be the good idea, good approach. So I think, okay, whatever the discretion trading that I'm doing, right? Anyways, I follow some system, I follow some rules, and then I use my discretion. So why not, create the fully quant based algorithm trading or quantitative trading? So that was my first initial introduction. And this is the realization which I also happen to have, that, after so many years of, uh, discretionary based trading, and spending a lot of time in front of the screen, still, you are just managed to get a 10 or 20% outperformance, right? So there was an initially very conflicting belief, in my mind, whether I should switch to the quantitative trading or I should not switch to the quantitative trading. Then, I have actually, put down all the things on the paper. I think, what is the probability or what is the statistical age, to use the quantitative trading compared to my discretionary trading. And then finally I made up my mind to, switch to the quantitative trading.
Got it. Got it. So let's follow up on that. In our last conversation, you mentioned to me that you can essentially show statistically that it's better to trade, in a quantitative manner. Do you mind sharing that whole philosophy?
Yeah. So basically, I'll just share, three main points, right? First point is that, let's say, there is a
Sure.
big if, right? The first big if is that you are the skill trader, right? Let's say there is a quantitative trading strategy, and which just keep on repeating itself, on every given signal, right? Basically, if you are a skill trader, what you generally do, you use your own discretion when to actually trade those strategy, or when you want to avoid the signal, right? And if you're a skill trader, you can still outperform the quant based strategy, right? But there's a big if called skill, right? One may have the skill, one may not have the skill. This is one part. Second part is that even though you are the skill trader, right? But let's say you are down with the fever, or let's say your family member is down with the fever. Let's say you want to go to some functions, right? Or let's say you want to go for vacation, for 1 month vacation. You are earning the money, so you should also enjoy your life, right? So you go for 1 month vacation, right? So that time, even though you have the skill, but you cannot outperform the market, because 1 month gone is gone, right? So that 10% outperformance compared to the quant based strategy due to your skill will still not be useful in that case. Second thing is that, I deeply follow the 80-20 principle, which says, 20% of your effort should give you 80% of the result, and not a vice versa. It should not be, right? Here, to get a 10% outperformance, with the manual discretion trading, you're spending 25% of your time. Let's say, we have the 24 hours a day, right? You're spending a 6-hour day to focus on the screen. You make your own discretion decision, and just to get a 10% outperformance, right? Which is again a not worthwhile for me. So these are the whole concept, which push me, to fully quant based trading compared to manual and discretion based trading. I have not talked about the risk management and entry and exit speed that quant can give compared to the discretionary trading, but they are still there. That is a statistical edge that I have.
Sure. Yeah. And maybe one thing I would add to that is, just the ability to back test and kind of walk into a situation, confidently, right? Because, as you mentioned, right, we have emotions that come up, and I may have had an amazing run of 5 years with no life crisis, but then let's say I'm dealing with a life crisis and I'm making discretionary decisions, who knows, how I'm going to react to the markets,
Exactly.
right? So it makes perfect sense.
Exactly.
Let's now talk about your slice and dice method, right? So basically, this is this relates to how you can use market data to help improve and build a profitable quant strategy Tell me about the slice and dice method.
So basically, I mean, let's say, if you're the layman trader, or if you're just beginner to the quant, right? Or even though, you are the expert with the quantitative trading strategy, right? This slice and dice method works very wonderfully, It just not give you the, the clear perspective, which data you should work on, which data you should trade on. It does not only limited to this, but it will also give you the speed of designing the very strategy very simultaneously, right? I'll give you the example how slice and dice strategy will work, right? So basically, um, uh, you just take an example of non-directional strategy. Let's take an example of straddle and strangle. Okay, let's make it very simple, and let's take an example of, let's say you are selling the straddle or strangle intraday. Let's not even include the overnight risk, right? So basically what you do, at 9:20 every day you sell the straddle, at 3:20 every day you square off your straddle. Okay, so this is a very simple strategy. If you run this strategy in any data for last 1 year of Nifty or Bank Nifty, or even in the Dow Jones or everywhere, right? You will get some return. For example, for Nifty, if I sell the straddle or strangle every morning and square it of around 320, I'll get a, let's say, 30% return. Okay, but these 30% return, I don't know where this 30% come from, right? So what I will do, I'll slice the market data in the two part. This is first slicing, right? I will call it as a trend, up trend or down trend. Let's say you can consider a 20-day moving average or 50-day moving average, even 200-day moving average as a first indicator, right? So more than these averages, it's a trend. Less than this averages, price is trading. It's called a downtrend, right? So now taste the same logic, selling the 920 to 320 straddle in the uptrend, and same strategy in the downtrend. You will see clear distinction that in uptrend you will get a 40% profit. I mean, you can check. I mean, this is not that much hypothetical data, but this is the somewhat related data. In uptrend, there is a 40% that you get a profit. In downtrend, when you sell the straddle, you are getting minus 10% negative, right?
20.
So ultimately,
negative 10,
how your 30% comes from, it's a 40% from the uptrend and 10% from the downtrend, right? So basically, if you are the good trader, you will totally eliminate the down part. You will only let your algo run, even it's a straddle or strangle, right? Only in the uptrend. There is a two benefit. One, your overall ROI will get improved. Your drawdown will get in lessened down. Your Sharpe ratio will improve. And foremost, the base thing is that the brokerage and transaction cost and slippage cost, which are the major hurdle for any trader, right? It will also get reduced. And yes, the losses also get reduced, right?
Sure.
Second layer is that since we are talking about the straddle and strangle, right? It's again related with the implied volatility and theta decay, right? So let's also add the element of IVs. Okay, so you in the uptrend there is again two segregation, two slice of the data. One is the high IV and low IV. Again, in the high IV you get a 30, low IV again you get a 30% return. High IV you get a 10% return. So even in the uptrend, there is a low IV you get a 30% return. There is a high IV you get a 10% return. So if I would be trading this system, I would put my all the money or go aggressive when the market is uptrending and IV is low. I'll sell the straddle with a heavy quantity.
Sure.
Compared to, I'll also sell the straddle when the market is uptrending and IV high, but with the normal volume. Okay, so that's slicing.
That makes a lot of sense.
That's how slice and dice make sense. Yeah.
Got it. So one kind of small follow-up question to that. Now, that on paper sounds amazing, right? And I'm sure it works really well. But one maybe question mark is how do you ensure that you are not kind of, I don't want to say curve fitting. That's not the right term here. It's more like kind of selectively looking for things which make a, which kind of make your case stronger, right? So if you're slicing and dicing across different sets of data and you just happen to notice that, when you're looking at this data, say it's uptrend, downtrend, or IV's high, IV's low, you notice that discrepancy. When do you know that when you notice that discrepancy, this is an actionable step versus it's just like, noise, that you should ignore? Like, how would you kind of generally think about that? Or like randomness.
Okay, yeah. So basically, I'll definitely say, there is a one thing, some of the time, I'll take a break from the quantitative analysis and I focus on the behavioral analysis. I mean, that is a much more very, ingrained concept in me, right? Let's say I need to understand what is the causing the market to move, right? uh, I will not, I will not trade anything, which is not, causing the market move. I'll create the quant based strategy by just observation with the Bayesian approach, and then, I create the strategy. So that is all much about it.
Got it. Got it. Got it. So you try to figure out the behavior and the underlying cause for
Exactly.
the alpha. That makes sense. Got it. Got it. Got it. So going back to that example, then let's notice, let's assume that you see that the uptrend generates a higher return. Then you would ask yourself, does this make sense as to why that would happen? Right? Got it. Okay. Cool. 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 Okay. Let's kind of, follow up with this whole quant based, topic. Designing a strategy, right? This is also something we've discussed. Is it an art or is it a science?
I would say, it's an art of implementing the science of quantitative analysis, right? Because as I mentioned earlier, that, you need to know what data, you have to select for slice and dice. In what manner, you also have to slice and dice, right? So if this two thing is clear, what and in what manner, then it's very, very easy for, to create any kind of strategy. It seems like, creating a food or cooking the food. Overcooked food may not taste great. The same way the undercooked food is also not great. So creating the full quant based strategy, you require, you are not too over optimize it, so it will not even generate a one or two trade, right? And even you should not keep it loose, without just, slicing and dicing. You just, randomly do that. It's not also good way. So how do you know that whether, you are actually at the peak of your art, right? So basically, let's say you're selling the straddle, right? You just compare your strategy Sharpe ratio with another comparable strategy. Let's say if another person is selling the straddle, right? What is their Sharpe ratio and what is your current Sharpe ratio? If your current Sharpe ratio is increasing or, similar like other strategy, or, it is better than the other strategy, then, you are actually doing good. But yeah, there is one caveat that, your number of trades should be exactly or equal to, that trade. It should not happen that you are generating just two trade and your Sharpe ratio is a very much higher compared to other guy, right? So number of trades should be also equally great. So Sharpe ratio, I would say, it's a key to go if you know whether you're doing it right correctly or not. If you are generating a Sharpe ratio let's say lesser than someone else, then you should choose or, subscribe to someone else's strategy than use your own strategy, I would say, right? So yeah, improve your Sharpe ratio is a key to go.
Sure. No, it makes sense. And that's why I love the Sharpe ratio. It just, kind of puts everything on the same playing field, right? Or the Sortino ratio, right? Exactly. Let's kind of follow up with this kind of, bifactor questioning. Is it more important to be disciplined or profitable?
Okay. So I would definitely say, so I there is a one show, in Money Control, just last 1 or 2 weeks. There is a webinar, right? I was there as a listener, and one speaker was telling me that, he should not focus on creating the algos for the profit. He is more toward, creating the algos for, just discipline. So I was wondering why this guy is saying so, right? So then, I was ponder upon a very deep thought. I ponder upon, let's say, maybe half of the night, right? Why is guy saying so? Why, discipline for discipline, right? Then I come to know, there is a one term called efficient market hypothesis, which says, and by the way, this very, very, very coincident that, this efficient market hypothesis founded by Eugene Fama. He's a professor in Chicago University, maybe nearby your places. I'm not sure. He found this efficient market hypothesis. So what does it tell? You cannot outperform the market return, considering the transaction cost and slippages cost, right? So to get the market related return, right? Market gives a 10%, so you get a 10%, right? So for that, you need to have a discipline, right? So maybe that guy may be right, may not be right. It's totally disputable. But yes, his approach may be to get the market return, and you are not, open with a lot of risk. So that's the reason quant thing is a discipline thing. But I belong to the second school of thought, who believes that, discipline is already embarked in the quant trading, right? You don't need to, look for some discipline to, create your algo. You're creating algo to outperform the market. and there is ample anomalies in the market. There is ample repetitive pattern which is unutilized, untouched, right? You just have to discover with your eyes or with your, the quantitative base, the method which I mentioned, slice and dice. You just slice and dice the data. You just see where the cream lies, and you just exploit that particular cream. You don't need to trade a whole market, right? So I would say create an algo for profit and not for the discipline. Discipline is already given if you follow it rigorously.
Exactly. And maybe the only caveat to that is, if you're a discretionary trader, right, then maybe first you should kind of focus on your discipline, right? Learn to put your emotions at bay and all that. And then at the same time, obviously focus on being profitable. But if you are an algo trader, that is why that's probably one of the major reasons why you are going algo. So you don't need to develop that quote unquote discipline. And you can just focus on being profitable, Yeah, so I do know about that. So interestingly enough, Abhi, when I was in college, I had a professor, he was a finance professor, right? So it was a finance class. And, he did this whole, session on how the markets are, very efficient, right? And he brought up that book, The Random Walk on Wall Street, right? Yes. And he basically argued that you cannot beat the markets, so don't trade or invest, right? And I got upset. I got upset in class. Like I never get upset in class, but I got upset. And I literally raised my hand and I'm like, how do you explain a Warren Buffett, right? And he's like, yeah, there's always going to be outliers, And that's when I realized, okay, I can't argue with this guy, But yeah, so I think what happens is when you subscribe to that line of thinking where you just assume the markets are efficient, then you're never going to approach it in a manner which can allow you to beat the market, right? You have to assume that you can beat the market, So cool. Let's go to the next question here. So the next question I had for you was, a lot of retail traders, they get involved with quant trading and they want to build systematic strategies and things like that. And they start trading. So they spend a lot of time, building the strategy. Then they start trading. And when they start trading, they don't see the results, right? They're not seeing a good ROI from that activity. What are some general considerations, to kind of keep going and to not give up?
So, see, there is two things, once, you build the quant model, right? And then you actually implement in the market, right? So maybe initially, if it isn't just, let's say it's a normal drawdown, right? Which your hypothesis stated, right? Then it's totally okay. You don't have to change the strategy, right? Let it run for, quite considerable time, let's say 3 months, 6 months. Still, it does not give the result. Then I'll suggest a point number 2, which is the point number 2. You should take a break from quantitative analysis for some time and shift your focus to the behavioral finance. I may sound somewhat weird because, quantitative finance is all about the data crunching and so on and so forth. And behavioral finance is all about the psychology, right? But you have to understand what is causing effect for price to move from one level to another, right? Which is not at all, given by the, quantitative analysis. Quantitative analysis only says price move from this level to this level. That's it. Does not give you what is the causality of it, right? I'll just give you the example.
Right.
So, layman trader couldn't understand, right? Let's say, I'll create one regression analysis of, correlation analysis. The example is very weird, but still, for benefit of our viewers, so it will, quickly catch up this particular thing. Let's say there is a donkey dies in the street of the Bombay. Okay. On one day, and what is the next day return on the Sensex, right? Let's say if you get the data from the BMC, Bombay Municipal Corporation, how many donkey dies on the street, and next day, how much Sensex has risen, right? If I put the data in alignment, right? If I do the regression analysis or, correlation analysis, I'll get a result between -1 to +1. I will get the result. It's not that, I will not get the result. Even with the unrelated data, I will get the result. Yeah. Whether it can be positive correlated, whether it can be negatively correlated. Let's assume, dying the donkey, higher number of donkey dies, Sensex rise, right? So I get a 0.25 correlation, which is a positive correlation. Maybe I'm a good coder. I just quickly code the strategy and I'll run it on the, thing. My strategy is working initially, right? Yeah. But some of the day it's not working, extremely, low, high drawdown. So I wonder why this quant-based strategy is not working, right? So that's the reason I'm saying, you have to understand the cause and effect. This is a very upfront example. Anyone can understand, right? But let's say, if I give the example, let's say, there is a lot of trader who sell when the RSI, indicator goes above 70. I mean, it's not at all a good strategy. Every time RSI hit above the 70, it means it is a bullish, right? I mean, forget about stock falling. It may go sideways. It will even go. If it is pick up momentum, it will go even higher, right? So lot of people
Sure.
selling the RSI when it's more than 70. They are buying when the RSI is less than 30. This is the same equal strategy like I mean, the donkey and Sensex analysis which I just put on, right? So there is a lot of anomaly. People think there is a correlation, but there is not a correlation. If you want to understand the correlation, you have to go with the behavioral finance. Behavioral finance is not an opposite of the quantitative trading. It's in fact cooperative to each other, right? In my view, it's like a yin yang, right? I mean, if there is a no black, there is a no white. Ultimately, people's drive the price and quantify analysis can capture those, ultimately behavior of the movement into the price, right? So if you know what causes the move in the market, right, then you can design your strategy very well. Apart from there, market also change its profile, right? Let's say market is momentum driven, right? Maybe fewer down the line when the market is maturing, it may be mean reverting. So even though you use a slice and dice strategy on your older momentum strategy, it will not work, right? So basically, I would ask trader, if you feel with some setbacks, just redesign your strategy. Take a break from quantitative. Look what is the causing the move or price to move, right? What is the property of the market? Mean reverting, trending. Use the related indicators and re-optimize your strategy or redesign your strategy, right? So that is the best way I could suggest to anyone.
Sure. Yeah, it makes a lot of sense, right? It's a classic case of causation versus correlation, right? Making sure that there's a clear causality, and it reminds me, when you're building a strategy in Excel or whatever it is, you test your strategy and you see that the results are let's assume the results are very bad, right? Like not just bad, but very, very bad. Then we just sometimes we have that kind of itch to just flip that -1 to 1 or flip that 1 to -1 and then run the back test again, right? And every time I do that, I have to catch myself. I'm like, actually that doesn't make sense because I walked into this whole thing thinking that this was going to happen. It doesn't make sense for me to just flip the whole thing by -1 just because I'm seeing a severe negative return, right? Like that's actually completely counterintuitive. So it makes a lot of sense. Let's kind of talk about just, one more question here before the last question. For someone who's looking to build, their strategy for the first time, right? So let's assume, I'm a discretionary trader and all this stuff sounds fascinating. Abhi has convinced me that I need to, switch over to quant trading. What are some good kind of first steps to get started?
Okay. So basically, I'm assuming that if you are the first time quant trader and you may not know the Python or other coding language, right? So you can always start with the Excel, very, very basic Excel. You can get the data in the Excel. You can use some formula to get the 20-day moving average, or you can also deploy the IVs data and so on and so forth. You can segregate all the data in Excel. That is a basic requirement, I would say. Once you have some logic in you backtest those data with the Excel, right? And once you're confident that they should work, you start deploying with the real money. Generally, people say you should start deploying with the paper money. I'm totally opposed to this view. Why? Because once you trade with the paper money, what happen? You are careless because your money is not on the line. When you're trading with the actual money, I'm not saying you trade with the 10 lakh, 50 lakh or 1 crore rupees. You just trade with 10,000, 50,000, whatever your comfort limit is. But once you trade with the actual money, your focus will get improved. So basically you will see that, what is the exact thing, why I'm missing this particular thing or why this particular thing is not working, because your money is on the line, right? So once you know once you know the Excel is there, once you know your strategy is there, put your real money at least somewhat and you can start. Second thing is that once you're new to the quant trading strategy and you don't know how the things work, right? So why not to roam around with some other expert quant trader, right? If they have some good strategy, you can just use that strategy. You deploy your money with that strategy. Just check how they manage the risk, how they manage the profit, and how they cut the position, what is the execution speed, and so on and so forth. So by mimicking those trades, you will get to understand that this has to be done to create a good strategy. So for beginner, there is a three thing: Excel. Use the Excel to start with. Deploy the real money, beat a small money, and use some other strategy to deploy in your account to get a sense how it's moving.
Yeah, I love that. 3 very actionable steps. Awesome. So Abhi, as a last question for today, I'm sure we'll have many, many more
For
conversations in the
sure.
future. But, as a last question for today, what are your goals, as a trader and as a whatever, just kind of being involved in these markets, over the next 5, 10 years?
So basically, I have been designing a lot of quant strategy. Around 7, 8 strategies live with me. So in next 5, 7 years, there is a first goal which I have is that I want to deploy this money in my account. I mean, my family account, my friend's account, and mostly in my parents' account. So these are the main thing. I want to deploy in my family and friends' account compared to other account. This is the first thing. And this also show me that confidence that I mean, I have the good strategy. So why not my family and friend will be benefited compared to others? I mean, first of all, right? Uh, Again, so this is first my goal that every of my family member or friends should utilize this strategy. First thing. Second thing is that after 5 or 10 years down the line, I don't see myself to work for the money, because let's say if the strategy is giving me the money, I'll work for my zeal or love for the trading, right? I'll design some new strategy. I'll check some other behavioral psychological aspect, try to quantify in the quant manner and algo manner. That should be my focus compared to earning the money. So yeah, in after 5 years down the line, I want my money, family to use this proprietary algo trading at their account. And yes, I don't want to work for the money. I mean, that is the two aim which I have.
Sure. That's amazing. Yeah. And that's an amazing way to get validation, right? Not that you don't have validation, but when you're actually getting your friends and family, the closest people to you, to say, yes, I believe in this, I subscribe to this. And then if you're able to do a good job for them, it doesn't get better than that, right? Uh, awesome, Avi. That was an amazing conversation. I personally learned a lot. What I really appreciate about you is you obviously are very mathematically inclined, but I think, this is a key element. You realize that, like you said, it's an art and a science, right? You can be as scientific as possible, but you have to understand the causality behind anything. Otherwise, it's like shooting yourself in the
Exactly.
foot,
Yep.
right? And you have to have that right mix. And you have to be objective, I think, with your decision
100%.
making, which you see, you clearly are. So it's very,
Thank
it's
you.
very impressive. Thank you so
Thank
much. And I'm sure our listeners will love this
Definitely,
episode.
I mean, it has been very great experience with you, being this podcast, and listener will get a lot of knowledge from our discussion. That is for sure. Yeah.
Awesome.
Thank
Well,
you very
thank you so
much.
much.